Welcome back to Alpha Recap. I'm glad you could join us. Lane here. We're unpacking the biggest market drivers from today's session now that the market close is in the books. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks, Lane. Great to be here. Today felt like one of those cross-sectional days. A mix of biotech headlines, strategic tech noise, targeted upgrades, and a handful of filings that mattered more than the headlines suggested.
Markets closed mixed today with pockets of strength in tech after the big Google and Apple story and notable moves in energy and some industrial names. Why don't we start with the biotech headline that everyone was talking about? Pfizer's phase 2 readout on a monthly GLP-1 obesity injection. Ryan, why did that land so heavily?
Because it touches on something very practical: dosing convenience. Pfizer reported mid-stage data suggesting their GLP-1 could be dosed once a month while maintaining efficacy versus current regimens. That's a potential game changer, because many of the adoption barriers for weight loss drugs aren't just efficacy, they're tolerability, cost, and the hassle of frequent dosing.
Help our listeners who aren't deep into pharma. Why does moving from weekly to monthly matter commercially?
Three big reasons. First, adoption and adherence. Fewer injections lower the burden on patients, so more people may start and stick with therapy. Second, competitive differentiation. If efficacy and safety hold up, a monthly product is easier to position against weekly injectables and even daily oral competitors. Third, pricing and market access. Payers will look at cost per month and may favor a monthly therapy that keeps outcomes similar. That said, it was phase 2, not definitive. We'll need larger phase 3 readouts and regulatory clarity before changing valuation models materially.
So it was an important signal but conditional. What would you say is the correct investor posture here?
Treat it as a re-rating catalyst, not as proof of commercialization. If you're a growth investor, model the upside but weight it by phase 3 and regulatory risk. For short-term traders, expect volatility in the GLP-1 complex. For long-term holders, keep an eye on payer commentary and trial design for the confirmatory studies.
Switching gears to tech, the Google and Apple interplay was the other headline. The market was waiting on Google's upcoming earnings call to clarify the Siri Gemini partnership. What's the debate among analysts?
Analysts are split on how material this partnership is to earnings. One camp sees it as distribution and usage upside for Google's Gemini model. Broader reach through Apple's user base could amplify models and services over time. The other camp cautions the announcement lacked financial specifics, so the near-term earnings impact could be limited or structured in a way that doesn't show up as revenue immediately.
So everyone's waiting for the earnings call to see whether it's mainly product integration or something more commercial.
Exactly. Investors want answers on deal economics, revenue share, data access, duration, and distribution scope. If the call gives even a basic framework, markets will recalibrate quickly. Until then, it's a strategic narrative more than a proven income stream.
We also had pockets of institutional re-ratings today. Bank of America upgraded Oshkosh and JP Morgan reshuffled the regional energy names, upgrading Galp and cutting Repsol. What was behind those moves?
Those moves were telling because they weren't about oil price direction so much as asset quality and profit mix. Oshkosh's upgrade was about stabilizing profit mix, predictable cash flows that can support multiple expansion. JP Morgan's work signals a tilt toward lower long-run production costs. They favored Galp on longer-lived, lower-cost barrels and trimmed Repsol, where the mix or cost profile looked less attractive. Institutional analysts are increasingly prioritizing longevity and cash flow durability over short-term commodity exposure.
And in industrials, there was partnership news. Mayer and Baker Hughes signed a memorandum of understanding on modular LNG projects. Why should investors care about that sort of deal?
It's about execution capability and project scalability. A non-exclusive MOU that pairs Mayer's project pipeline with Baker Hughes' modular execution tools expands Mary's runway without necessarily blowing out capital needs. For investors, this is a structural play on platform and execution risk. If these modular approaches scale, they lower construction timing, cost overruns, and permit faster cash flow ramps.
Let's talk about the filings because a bunch of Form 8Ks landed and some had outsized implications. SemiLEDs got a delisting notice. The Federal Home Loan Bank of Indianapolis disclosed a new direct financial obligation, and firms like Transdig, Sangamo, and Nucleus filed exhibits that could matter. Why do 8Ks keep showing up as such market movers?
8Ks are primary sources of material information. They're often binary and immediate. Delisting notices reduce liquidity and can crater valuations quickly. New direct financial obligations change credit profiles. Governance moves or material contracts can alter upside or downside. For small caps especially, an 8K can be the difference between survival and a forced restructure. That's why investors should triage filings by item and read exhibits. The detail lives in the annexes, not the press release.
Practically speaking, what should investors do with those filings? Do they need to read every line?
If you hold the stock, yes, or at least read the items relevant to your exposure. Focus on delisting notices, new obligations, covenant language, compensation changes for management, and any restatements. For many funds, the filing is a trigger for a risk review. Retail holders need to be especially careful. A delisting notice can make an otherwise liquid position illiquid overnight.
You mentioned earlier that the day highlighted a couple of cross-cutting themes. Walk us through those briefly.
4 themes stood out. 1. Catalyst-driven revaluation. Upgrades and the Pfizer news were classic catalysts that reprice expectations. 2. Product cadence and convenience. Dosing frequency in biopharma and long-run extraction cost in energy are becoming real competitive axes. 3. Information asymmetry. Filings are where asymmetric information hides and can change risk profiles fast. 4. Strategic platform plays in energy and industrials. Partnerships that improve execution matter more than commodity calls.
Were there notable disagreements or debates among analysts today?
Yes, the Siri Gemini story was a big split. Some see immediate strategic upside for Google's model. Others say there's no clear short-term revenue lever yet. In energy, analysts differed on whether you pick producers based on low long-run costs or target names with near-term production upside. And on filings, funds differ on whether to de-risk immediately on a delisting notice or wait for exchange action. That's often driven by liquidity needs and mandate constraints.
Let's make it actionable. How did these developments affect different investor types?
Growth investors should focus on Pfizer and Google. Pfizer's monthly dosing could expand the addressable market if it's replicated in Phase 3, and the Siri Gemini disclosures could be a multi-quarter lever for Google. Value and income investors should look at Oshkosh and energy names favored for low-cost structures. Those offer more durable cash flow and potential dividend support. Event-driven and activist funds will find opportunities in the Mayor Baker Hughes MOU and the 8K roster. Those can be sources of arbitrage or catalyst acceleration. Retail and momentum traders need to be cautious. Small cap filings and biotech press releases can generate sharp, binary moves.
What should listeners be watching next? Near-term catalysts that could move markets again.
Key items. Google's earnings call. Look for quantitative disclosure on the Siri Gemini terms. Follow Pfizer for Phase 3 study designs, regulatory timelines, and payer signals. Monitor SemiLEDs for any exchange cure filings or reverse split announcements. Watch the Federal Home Loan Bank of Indianapolis for follow-up on the obligation size and maturity. And for Transdig, Sangamo, and Nucleus, open the 8K exhibits to see if there are restatements, covenant triggers, or material contracts.
Before we wrap, give our listeners 3 practical strategic takeaways to use when they look at days like this.
First, trade catalysts, not headlines. Use position sizing to limit binary event risk and scale into post-data conviction. Second, prioritize filings for any small cap or recently newsy company. The exhibits often contain the truly material detail. Third, differentiate structural from timing signals. Think of Pfizer's dosing cadence as a structural TAM change and PepsiCo's sequential growth as operational seasonality.
Great. To sum up quickly, Pfizer's Phase 2 monthly dosing was a meaningful signal but not definitive. The Google Apple story needs earnings call detail to move from narrative to financials. Institutional upgrades showed a bias toward durable cash flows. And a set of 8Ks created real idiosyncratic risks that investors should read closely. Any final thought?
Just one. Days like this reward active information work. The market handed out both durable structural signals and quick, high volatility filings. If you pay attention to the secondary documents and scale your risk, you'll find opportunities without getting caught off guard.
Fantastic. That's our recap. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. I'm Lane, and thanks, Ryan, for the perspective.